Welcome everyone, and thank you for joining us today for this webinar, Navigating the Future of Insolvency in the Crypto Era. Today's agenda will explore how blockchain and crypto assets are reshaping the insolvency practice, examining the opportunities, challenges, and the interplay between traditional finance and the digital world. I'm David Huntstone, and I'm pleased to be hosting this session with Hadley Chilton from Cork Gully.
Thank you.
For those unfamiliar, Cork Gully is a trusted advisory firm focused on bringing clarity to restructuring, recovery, and insolvency scenarios. Based in London, but working globally, Cork Gully is known for leading tough, complex assignments, often at short notice. They have a reputation for agile thinking and insightful decision-making, helping clients to navigate critical moments with precision. They are prepared to take on high-risk engagements, often at short notice, with the skills, tenacity, and vision to deliver results that preserve and enhance value. Hadley is a senior offshore insolvency practitioner with extensive experience in managing complex insolvency cases, including those involving crypto assets. His expertise in asset recovery, with a deep understanding of both traditional and digital finance systems, make him a leading figure in navigating the challenges of crypto insolvencies. Hadley has extensive experience in providing governance and leadership in complex cases, from shareholder activism to bondholder enforcement, succession management, and high-profile asset recovery. Hadley, thank you very much for joining us today.
Thank you.
Hadley, to kick us off, I'd like to ask, blockchain's having a huge impact across industries globally. How has it changed the way insolvency practitioners operate?
Thank you very much. It really has sort of transformed the profile a lot of the leading insolvencies, certainly in the jurisdictions where we operate, which is mainly the financial services centres. In terms of the technology has a lot of different uses and sometimes is seen to be a solution looking for a problem. But counter to that narrative, we've also had the heads of BlackRock and HSBC and other global traditional finance players really have committed billions of dollars to the future of their blockchain business. So in terms of, is it a niche sector of an asset class of the insolvency market? It really is sort of creeping in to be all pervasive. Of course, up until now, a lot of the matters have been based upon scams or frauds or illiquidity problems with huge exchanges and things of those types. And those are what have grabbed the headlines because of the fraudulent nature. People have lost their wealth, their savings, and things like that. It's been quite impactful, FTX being the lead one, but there are many other large ones as well, both within the US and outside of the US, based in different jurisdictions. But taking a step back, the reason I think the adoption seems to be gathering pace so quickly is because it does deliver an element of transparency, cost savings. The immutability has features as well, which could impact all sorts of industries, whether it's traditional investment finance or trade finance, or there are applications being looked at and implemented in the last 5 to 10 years, really across the board. So the way we look at it is it's not a sort of niche area of insolvency, and financial services is different, and private wealth is different, and treating it as a separate thing. We think it's going to be partly underpinning all of those traditional businesses to an extent going forward, and it won't necessarily push all of what we know of traditional finance out the door immediately, but there will be a level of interconnection, and I think it's fair to say that the industry has really sort of moved apace in terms of getting the skill sets necessary across the board, whether that's in the legal side, on digital forensics, or investment management. It's really the pace of change has been exciting, I'd say, as well as very fast.
It's certainly a fast-moving space, both in law and in finance.
Yeah.
What from your position, what do you see as the key advantages that you see in the evolution of blockchain?
Well, I think cost is quite a big factor. I think in terms of moving transactions out of traditional, and by cost I don't just mean specifically the initial cost, but also the cost of the time of doing business. If you can bring transaction times significantly down whilst retaining trust in the system, then that really does have implications. There's a lot of inefficiencies built into the systems as we know it in finance, and I think certainly the idea of the sort of blockchain evangelists will certainly say that all of these traditional inefficiencies will be eradicated by the advent of blockchain. I think there will be certainly some areas where it's been incredibly useful. I think certainly when you're dealing with investors or creditors who have lost money, the transparency of blockchain transactions is certainly a factor that we as insolvency practitioners wouldn't have had before. We wouldn't have had creditors or stakeholders tracing, for example, bank account movements or transactions of those ilks live, parallel to what we're doing within the liquidation or the insolvency proceedings. So that introduces its own issues, but of course, every time there's a transaction, all the creditors want to know what it was and why it was. And you really do have to make sure that you've got systems in place to have adequate reporting and transparency from the IP to your stakeholders, but equally that you are not getting sidetracked and spending thousands, hundreds of thousands of dollars or pounds essentially dealing with people trying to replicate your process and what you're doing in terms of asset tracing or gathering in the assets of the entity involved.
So the key advantages there, it sounds like, is the speed of discovery. Am I right in saying that?
Yeah, the speed. I think the ability to trace on-chain transactions is very useful. It's not the silver bullet. We can certainly trace a lot of transactions that are traceable by anybody with an internet connection, really. But I think there are systems in place. There are a number of leading players who've emerged in terms of the on-chain analysis of transactions, and those tools are very, very useful in tracking down transactions and where assets have gone. But of course, then you've got to. It's all very well knowing where assets have gone, but is that the end point? Where do those assets rest right now? And there are blockers in place or complications in place, such as where those transactions move into an omnibus pool of assets, such as with an exchange. So there are some areas where some further analysis and technical analysis is needed, but it certainly helped. We can certainly identify certain wallets and look at the transactions that have happened with those wallets. And of course, where these days with most of the exchanges taking KYC in most of the relevant jurisdictions, that is an extra element, just like you would have when you go to a bank as an insolvency practitioner and request the account details of an account that you've traced assets into. These days, the exchanges are a lot more receptive and helpful and speedy in terms of how they assist you in terms of providing details about the account, the KYC of who opened it, and potentially seizing assets. If they can see that there are assets held separately by that account holder to which you have the right to the assets, they will put the onus on the IP to run off to the relevant court and get a freezing order, but they will act on those freezing orders. I had one particular example of a contact of mine who was at a crypto conference where somebody had been a few $100,000 had been scammed from him using a clone type of wallet. But luckily, his lunch table was the head of financial crime for 2 of the large exchanges and 1 other business as well. And I think before they had afternoon drinks after the seminars were concluded, they'd already managed to effectively freeze the account temporarily by refreshing the KYC of that account, whilst that particular person was able to run off and get a court order. So speed is great if you have the information to hand and you happen to be sitting next to the head of
That's a very fortuitous
relevant exchanges. Yes, yeah, indeed. This is a new area. I think everybody in the insolvency market is, particularly people dealing on larger or international cases, that we're all grappling with the challenges and the opportunities and trying to make the most of those. The one thing that is very dear to creditors is that you do a thorough process, of course, but the second thing that feeds into that would be the speed of the process. It's all very well if you're going to get 40 cents back on the dollar or 40 pence in the pound. If you get that within a year or 2 years, that's a lot better than obviously if it's 5 to 10 years of a process of asset tracing around the world and opening proceedings perhaps to recover assets. And it does seem to have been, on balance, anecdotally at least, an enabler of more efficient return of assets available to creditors. That's been a very positive development as far as we're concerned.
Yeah, it's good to cover the advantages, and you did mention there that they're about some of the challenges as well. I suspect that volume of data and stuff to go through could be a potential challenge. Is it? I'm keen to hear your thoughts on if there's any more that we haven't covered there.
Yeah, certainly in terms of the challenges, sort of finding the wheat from the chaff in terms of when you're doing your analysis of transactions. That is time intensive, but also there are tools, particularly with AI as well. There are tools that really do cut down the traditional asset tracing and financial analysis tasks from what would have taken weeks and months to days and weeks. So those elements are being addressed. The better the tools that develop in this area, obviously, the better returns we're going to see for creditors. In terms of seizing assets, there are some complications. Of course, we can trace and then apply to the relevant court for freezing orders or other sort of relief to protect those assets and take control. Part of the problem is, of course, if you identify a wallet, a particular wallet, part of the problem with that is where is the person who controls that wallet? And the courts have tried to be quite innovative, particularly in the US and the UK and the territories that have English common law. The laws develop quite quickly there to specifically address these problems. You've got things like you can issue legal documents via NFT, non-fungible tokens, so that that can be sent down to effectively to communicate that order in a way that is not trying to identify a physical address and send a letter in the traditional way. So things like quite simplistic areas, one would think, like service of documents, which are, I'm sure the lawyers listening will say that's not a simplistic area at all. But the things that are more mechanical, that's been enabled by this technology. In terms of the asset custody as well, that's obviously quite a challenging area to get right. Having custody of assets that might be very volatile, it brings into question the insolvency practitioner's duties to reduce speculation of the asset, the liquidation estate, and to convert the assets into the currency of the estate. We've got issues there where, for example, you might have investors who are creditors on a system, on an exchange, for example, who have never been exposed to and were not contractually exposed to the traditional, the US dollar, the pound, the euro, the Hong Kong dollar, whatever it is, because they're in a jurisdiction where For example, the Seychelles rupee is one situation where we have, and there is no expectation that an international business company that by definition should not be trading in the Seychelles, there's no expectation that those people should be having a liquidation that's denominated in Seychelles rupees. But then, of course, we've got a situation where there are no US creditors either, and they're dispersed over Europe and Asia mainly, and some in Africa. Of course, each of them has their own opinion about whether we should be holding 100% Bitcoin, a mixture of Bitcoin, Ethereum, Solana, even some of them suggest a basket of alternative coins, which is not attractive. But there are a range of ways that sometimes you can address these, and we've settled on a couple of ways that we think will be both commercial and having the investors' interests, the creditors' interests at heart. But equally, we've very usefully got a very engaged committee on the particular case I'm talking about, and we've come to a solution that's worked very well for keeping in mind our duties as an insolvency practitioner, not to be furthering speculation of the assets and to reducing them to something that is fairly risk-free.
Thank you, Hunter. That's a really good kind of balanced view of both advantages presented, but also challenges. I guess the question that's on my mind and probably a number of the viewers is how does this impact on the costs involved in a liquidation? What are your thoughts on that, please?
Yeah, there are a few recurring themes that we have. I think the barrier to entry, if you like, for a situation we're talking about more traditional sort of exchange failures or some sort of investment in inverted commas business that's failed. Looking at those, I think the problem we have there is quite often we've got a lot of very small creditors in terms of the size, and of course losing any money is important to each of the creditors. But if we're talking denominations of say a few €100, a few $1,000s, then there is a question of whether any creditor would have standing to have the wherewithal financially to bring insolvency proceedings, to start the ball rolling, to seize assets, and even outside of insolvency proceedings to engage lawyers and to set about obtaining information, obtaining potentially freeze orders, and of course police forces and regulators around the world. Anyone involved in financial crime from the criminal side, they're overwhelmed as it is. I'm sure pretty much every force you speak to would say that one of the main problems is having the resourcing and being able to focus on certain areas. So that's often an area where we see creditors venting their disappointment. But that's not to say there haven't been some major victories, but they naturally tend to focus on bigger cases. So there's that barrier to entry just because of the costs of the on-chain analysis and tools, and just the way the cost of legal fees and the barriers to entry are quite high, and it's probably a little bit higher because of the crypto element. But once proceedings are underway, we found significant reduction in the time spent on various tasks because of the tools available and the nature of the transactions. We've found that we've been able to be fairly efficient compared to, say, looking at more traditional financial services frauds cases. That would definitely be an area that's been appreciated by certainly by our creditors committees and our creditor bodies. Unfortunately, a lot of them will have been affected by perhaps investments in the global financial crisis of 2008 and onwards, and then potentially multiple of these crypto blow-ups, because I think quite rightly to manage risk, people have used multiple exchanges, and we've got creditors who, in cases of ours, who also have FTX claims, Celsius claims, all the rest of it. So there is an area of there's an expertise being built up, but there's an area of people who are in this sector for investment purposes who have been burnt multiple times, but will have also, unfortunately, developed an appreciation for how these proceedings are managed, and perhaps can contrast the post 2008 insolvencies that they may have had investments or other losses incurred to what's happening now. I think there's a lot gone wrong in crypto, but also there's the way in which the insolvency proceedings seem to have leveraged the experience from traditional finance blow-ups, plus the technology available and the advantages of that technology that we've touched on, and really to turn around something that is a lot more. It addresses the creditors' concerns a lot more quickly. As I say, they obviously want high returns of their losses, but also speedy returns of as much as possible, as soon as possible.
That's very, very interesting. That you mentioned a few insolvencies there that have heard in the media, but I wonder if there are any novel issues that you can share that specifically crypto insolvencies have brought about.
Well, I think determining the ownership of wallets is an issue that has come up, because I think people were quite excited when coming into the space, thinking, well, if everything's on the blockchain and everything is visible by everybody, then our job as asset recovery and asset tracing professionals is going to be far easier. And then we all sort of, anyone coming into the space will have dealt with the issue of, okay, I've identified wallets of interest. What next? How do you go about seizing assets in those wallets and gathering further information about who's owning or controlling those wallets? That's an area that's evolving. It's an area where there have been successes, and that's technology successes as well as the law evolving with us. And another area where the status of digital assets as an asset and not a currency, one thing that is quite dear to anybody involved in recovering monies owed from a company that might be insolvent is you're currently not able to issue a statutory demand for repayment in the normal way that if somebody owed you money, you could do, because of the nature of these assets. You have to approach it a different way. That's not to say that you won't get there in the end. It's just that the traditional creditor method of recovering from a potentially insolvent company is not available at the moment. And you have to look at things like breach of contract, or where there is fraud involved. You may be able to wind the company up on just an equitable grounds, where you can show that there's a fair amount of indicia of fraud or mismanagement, depending on the jurisdiction. I think that is an area an area of law that can be very successful.
So it kind of takes me back to the conversation we were having at the beginning. It's about the speed of evolution, and you've got these two worlds essentially colliding: traditional finance and the crypto world. The interplay between those two worlds. I'm keen to see if you can expand on that and give us your views from where you see things.
Yeah. Well, one of them, it goes back to one of the challenges as well, or features of this space, where you might have proprietary claims. So when you've got an insolvent company, you're collecting the assets of the company and share them, whatever's left, with the creditors generally after the cost of liquidation. But you will have some people coming along saying, well, no, I've still got right and title to that asset. It's not the company's asset. It actually is retained and owned by me. And that, of course, that issue comes along with wallets that might be sitting on an exchange. And of course, I think depending on the terms and conditions as well, which that can affect things, the way the terms and conditions have been drafted. I have to say that most of them that I've seen so far in blow-ups have not been very clear, to put it politely, as to where people's proprietary claims might lie. Some have been clear, but then there's another document or course of dealings that cuts across that and says, you've got these rights, but actually the way that thing was managed, the assets were all pooled anyway. So if you do have somebody coming across claiming the right title to a wallet, if it's a hot wallet where effectively they have a ledger balance just like you would have with a bank account, and in fact the assets are being pooled behind that, then there are issues with that creditor being able to prove the retention of ownership of that asset, whether it is separately identifiable. There are some arguments to be run there, but that's an area where I think liquidators do have to be careful and do have to get the right legal advice in the right jurisdictions and creditors as well, to make sure that the matter is sorted out in the correct way and in the correct timeline. But in terms of we've got quite some developments in the legal strata of various jurisdictions that have gone more quickly than others. One of the key questions that we get is, why was such and such a business set up in the Seychelles? Why was it set up in some other jurisdiction that they haven't heard of and perhaps haven't read in the terms and conditions? And in a sort of fairness, only a few years ago, there really weren't any regulatory guidelines in the UK and the US and other areas of the world. So you did have in smaller jurisdictions, perhaps, that could be more agile because their laws are focused on financial services, that could come out with a framework more early. And those frameworks have evolved as well. And it's then up to good faith actors who are launching a business in the sector. It's up to them to then choose a jurisdiction that not only allows them to trade in the way that they're trying to achieve, but also that will stand up to scrutiny, stand up to enhanced due diligence by creditors mainly, stakeholders mainly, but also regulators in other parts of the world who might be seeking to protect their people from difficulties. We are seeing a lot of migration in the past 2 or 3 years from jurisdictions that are traditionally more difficult for a creditor to have a claim against the company, and to the more traditional jurisdictions. I think it's fair to say that probably Jersey, Switzerland, Cayman Islands and BVI have been particular beneficiaries of that, in that the better business really has been trying to migrate to places where there really is a body of law, a body of expertise, and jurisdictions that are already used by the traditional finance quite in a very day-to-day fashion. So that's been a real benefit for those jurisdictions. Of course, where there are problems, big exchange blowouts with many thousands of people involved, there is always going to be a question about the jurisdiction, as well as the management, as well as the regulation. The regulation is evolving. I think Europe, and it might have initially surprised some stakeholders in the sector, but Europe did come out with their regulations relatively early compared to some of the other jurisdictions. It's not perfect. I don't think anyone would, with a straight face, suggest that it is, but it does allow people who really do want to open up a business that's meant to be an evolution of a traditional finance business. It allows them to open up and have some level of regulatory certainty. So you can speak to a regulator and say, look, we're looking to do this. That you've already, in traditional finance, you're already very familiar with that. How do we set up so we can be well regulated, so that we can go to retail customers, but also talk to us about how we can help you regulate us? Is sometimes the conversation that has been spoken about with a lot of the people in the legal world that I've spoken to. They said that's a dynamic that has worked quite well in some jurisdictions, where the regulators have sat down and said, right, we need to go through where the risks are, how these risks are covered off, how you're going to do it, ideally better than what we already have with traditional finance.
Yeah.
And how do we effectively regulate you? We could print all the regulations in the world, but is it going to be effective? Is it going to enable people to evolve business and move business forward, make it more efficient, but with adequate protections for participants?
Mm-hmm. Thank you, Heather. Again, it's the thing that keeps going in my mind is the speed of evolution of this space, and I'm wondering again from your seat where you see the future of insolvency in the crypto space, and where you have a sense of where things may lead us.
Yeah, I think certainly the tools that insolvency practitioners use, it will continue to evolve and be more effective. And part of that will be necessarily built into the way business is evolving. If blockchain as an underpinning for business is enabling transparency, is enabling immutability of records, and a very efficient review and analysis of records, then of course that will translate to the way insolvency practitioners not only do their job, but the way they're already enabled by the way the companies are run. That would be a very good evolution of all sorts of service providers, not just the insolvency practitioners, and the liquidation itself in terms of the cost and the time it takes. We should see liquidations become yet more efficient because of these developments in technology. It's quite an exciting space, and we're seeing new businesses try to evolve the space on a fairly regular basis. You've got just because of the nature of the industry at the moment, you've got quite a heavy level of correspondence between the IPs amongst creditors themselves, but also between the IPs and their creditors. That is potentially very useful if you're dealing with a case where you need to trace assets. The more information, the good information you can have coming in about interactions, either messages on Signal or WhatsApp or Telegram, or about transactions themselves that you can point to on chain. And I don't think I've mentioned yet. Of course, if you are running a scam of any description, it only becomes really useful where you can take assets off chain and into the real world, and those tend to be the traditional things like real estate or valuable items. And the exchanges are going to be going to be a big part of that, being able to identify where assets have been off-ramped and where to. So you may be able to point to bank accounts and then go and in the traditional way trace the assets through the banking systems. You may be able to, particularly if the real estate area is being developed on chain, you may then be able to more quickly go to properties, physical properties, and see which pieces of real estate are owned by who. So I think there's going to be some developments that really cut to the chase for IPs more quickly, and potentially in the first place make it more difficult for criminals, people of criminal intent, or people who slide into from having set up. We've seen this time and again. People have set up a genuine business, got into trouble, and sort of wrongfully continued covering their tracks. In those scenarios, people do tend to want to have a nest egg of assets that's available, first of all, to defend themselves if they are caught up with in illegal proceedings, and second of all, to have the gains that they were seeking to get from the activity that they've carried out. So I think there will be some evolution. Every time there's evolution, of course, criminals are, they would stay a couple of steps ahead, but also, at the very least, thinking of the same problems and potential what they would see as solutions from their side. But I think that element, the insolvency practitioner's job, we're really going to have to leverage technology in a way that perhaps 5 years ago we were only thinking about. I think that the time is now. It is happening now. The better we can leverage technology and those new skill sets, then the more successful we're going to be with recovering assets for creditors.
Thank you, Hadley. I think that brings us to the end of today's discussion. But before we wrap up, I'd just like to speak to the viewers watching this. If you or your clients are facing challenges, particularly involving crypto assets, Hadley and his team at Cork Gully may be able to help. Please feel free. I'm going to pop Hadley's details up on screen now. So please get in touch directly with Hadley. Hadley, would you like to add anything to that?
Yeah, I think thank you very much for the conversation today and for the questions and the kind introduction in the first place. I think with Cork Gully, we are in a lot of the major financial services jurisdictions, but equally we are expanding very quickly as well. But more to the point, our team really does have very global experience of asset tracing, of liquidations, and of wider corporate finance as well. But one of the things that would recur in any distressed situation, whether that's an insolvency, a fraud, or even mergers or family situations that are challenging, one of the key things is that we at least have a conversation early. So I would say that if you're facing difficulties in traditional finance as well, but with crypto matters, then the sooner we can act, the sooner we can strategize, the more options we may have. Because we've seen time and again Telegram groups of creditors who've been talking about something for 18 months, and that delay just really does work against them in terms of asset tracing and the complexity of asset tracing thereafter, and the fact that the assets that have been taken may have been used up and not in ways that can be recovered. So speed is of the essence, I would say. We can always have a very frank conversation, and we try to be very thoughtful with our solutions, and not just sort of say, well, these are our tools, how are we going to make your problem fit our tools? We like to be very expansive in our solutions offered. We have a very wide network that we work with as well, so we have to say, if it's not for us, and if you'd be better placed going to a certain person that we know well in another jurisdiction perhaps, we're very happy to put those connections in place. But the key is, if we're going to be strategizing about an asset recovery or an insolvency matter, the sooner we can get in, the sooner we can act, at least display the options, and people can review the options and take the action they wish to take, the better, and the more likely success is going to be.
Great, understood. Thank you so much, Hadley. Thanks for going through that with us. Thank you everyone watching today. Hope you enjoyed the webinar on the future of insolvency in the crypto era. Leaves me to say thank you once again to Hadley. Thank you at home, and we'll see you next time. Bye bye now.